Somewhere between 2020 and today, the housing market in America broke. Not collapsed, broke. Prices doubled in many markets during the pandemic boom. Then mortgage rates tripled. And instead of prices correcting the way they were supposed to when rates rose, they stayed elevated, stubbornly, historically, because the people who bought at 2 and 3% rates in 2020 and 2021 refused to sell and give up their mortgages. A phenomenon economists started calling the lock in effect, which crushed inventory and kept prices from falling the way basic supply and demand logic said they should. The result is that in 2026, you are looking at a housing market where the median home price in the United States is sitting above $400,000. Mortgage rates are ranging between 6 and 7.5%, depending on the loan type and borrower profile. And the monthly payment on a median priced home with a standard down payment is somewhere between $2,800 and $3,200 before property taxes, insurance, and maintenance. And somewhere in the middle of all of this, the cultural script has not changed. People are still being told that renting is throwing money away, that buying is always smarter, that you are not serious about your financial future until you own. That message, which was debatable even in normal market conditions, has become genuinely dangerous in 2026 because the numbers, run honestly in the current environment, tell a different story for a significant portion of Americans who are being pressured into buying before the math actually makes sense for them. This video is about what those numbers actually look like, not the emotional argument, the financial one. What renting versus buying actually costs in 2026 in real terms in real markets with real interest rates, and why for a meaningful percentage of Americans right now, renting is not the financially inferior choice, it is the financially correct one. 1. The mortgage payment is not the cost of owning. Here's what actually is. When someone compares buying to renting, they almost always compare the mortgage payment to the rent. That comparison is structurally wrong because the mortgage payment is one component of the cost of owning. Here's the full picture in 2026. On a $400,000 home with 20% down, $80,000, you are financing $320,000 at a 6.8% interest rate, which is representative of a 30-year fixed mortgage in 2026. Your principal and interest payment is approximately $2,100 per month. That is the number most people stop at. Here's what they do not add. Property taxes in the United States average approximately 1.1% of assessed value per year nationally, but in states like Illinois, New Jersey, Connecticut, and Texas, effective rates run between 1.8 and 2.2%. On a $400,000 home at the national average, that is $4,400 annually, $367 per month. In high-tax states, it is closer to $7,000 to $9,000 per year. Homeowners insurance has undergone a dramatic repricing in the past 3 years. In Florida, average annual premiums now exceed $10,000 for many single-family homes. In California, major insurers have left the market entirely, leaving homeowners on state plans that cost significantly more than private coverage did. Nationally, average homeowners insurance in 2026 is running $1,200 to $2,000 annually for a median-priced home, up 40 to 50% from just 4 years ago. Call it $150 per month as a conservative national average. Maintenance. The standard rule of thumb is 1 to 2% of the home's value annually. On a $400,000 home, that is $4,000 to $8,000 per year. $330 to $660 per month. This is not renovation or upgrading. This is a roof that lasts 25 years and costs $15,000 to $20,000 to replace. An HVAC system that lasts 15 years and costs $8,000 to $12,000 to replace. A water heater every 10 to 12 years. Plumbing, windows, gutters, paint. All of it is yours. All of it arrives without a warning, and all of it comes out of your pocket. Add it together, principal and interest, $2,100, taxes, $367, insurance, $150, maintenance reserve, $400. That is approximately $3,000 per month on a $400,000 home before you have paid a dollar toward anything else. In many markets, Boston, Seattle, Denver, Austin, Phoenix, the median home price is substantially higher, making these numbers meaningfully worse. Now compare that to what you pay when you rent. The rent. That is it. Maintenance is the landlord's problem. Insurance is a renter's policy that costs $15 to $25 per month. Property taxes are not yours. Your monthly exposure is a single number, and it does not have a catastrophic surprise attached to it. 2. What a 6.8% mortgage actually costs you over time. Most people understand that higher interest rates mean higher payments. Fewer people understand how dramatically the composition of those payments changes at higher rates. On a $320,000 loan at 3%, the rate many buyers locked in during 2020 and 2021, Your total interest paid over 30 years is approximately $166,000. Your monthly payment is $1,350 on the same $320,000 loan at 6.8%. The 2026 rate, your total interest paid over 30 years is approximately $432,000. Your monthly payment is $2,100. Read that again. At 6.8%, you pay $432,000 in interest on a $320,000 loan. You pay back more than double what you borrowed in interest alone before a single dollar of principal is retired in any meaningful sense. In the first year of a 6.8% mortgage, approximately 90% of every payment goes to interest. You are a decade into the loan before the principal paydown becomes significant. This is not a criticism of mortgages. It is a description of what high rate debt actually costs. And in 2026, this is the debt that buyers are taking on. While people who bought at 3% are sitting on assets that have appreciated significantly and carrying financing costs that are less than half of current market rates, one of the primary reasons they are not selling and one of the primary reasons inventory remains constrained. The person entering the market in 2026 is not entering the same market that existed in 2020. They are entering a market with prices calibrated to a low rate environment, but financing those prices at a rate that has more than doubled. The combination, high prices, high rates, is one of the worst affordability environments in American housing history. By some measures, the worst. 3. Home prices in 2026 relative to income. In a healthy housing market, the general guideline is that a home should cost between 2.5 to 3 times your annual gross income. At that ratio, with a conventional down payment and reasonable carrying costs, the math tends to work. In 2026, the median household income in the United States is approximately $80,000. The median home price is approximately $415,000. That ratio is approximately 5.2 times annual income, well above the historical guideline, and at a level that, when combined with current mortgage rates, produces monthly payments that consume between 35 and 45% of gross income for a median earning household. The traditional ceiling for a sustainable housing payment is 28% of gross income. What this means practically is that a median earning American household buying a median priced home in 2026 at current rates is financially overextended by historical standards before they have paid a single dollar in maintenance, before they have contributed to retirement accounts, before they have built an emergency fund, before they have addressed any other financial priority. In coastal markets, this is dramatically worse. In San Francisco, the median home price is over $1 million. In New York City, similar figures. In Los Angeles, Boston, Seattle, Denver, and Miami, medians range between $550,000 and $900,000. The income required to comfortably finance those purchases at current rates, using the traditional 28% guideline, does not match the median income in those markets. In many cases, it does not match the 75th percentile income. The market has not adjusted to the rate environment. The prices have not come down to restore affordability, which means the buyer in 2026 is absorbing both the high prices and the high rates simultaneously, a combination that makes the financial case for buying weaker than it has been in a generation. Tip 4. The insurance and property tax crisis that nobody is talking about enough. Climate risk has repriced homeownership in large portions of the United States in ways that were not visible 5 years ago and are now impossible to ignore. In Florida, major insurers including Farmers, Bankers Insurance, and others have either left the market entirely or dramatically raised premiums. The state-backed Citizens Property Insurance, which was intended as a last resort, is now the largest insurer in the state by default. Average premiums for a standard single-family home in South Florida now exceed $12,000 annually. In some coastal areas, insuring a home is simply not possible through private markets. In California, State Farm, Allstate, and other major carriers have stopped writing new homeowners policies in the state. The California Fair Plan, the state's insurer of last resort, now covers hundreds of thousands of homes and has faced solvency questions following major wildfire events. Premiums on the Fair Plan are substantially higher than comparable private coverage was 2 years ago. In Louisiana, Texas Gulf Coast, and parts of the Southeast, similar dynamics are playing out. Insurance costs that were a manageable $2,000 to $3,000 annually are now $4,000, $6,000, $8,000 or more, and still rising as carriers reprice for climate risk they can now model more accurately. Property taxes are also rising across most of the country as local governments reprice assessments following the home value increases of 2020 to 2022. In many states, tax assessment caps that kept bills artificially low for long-term homeowners are recalculating for new buyers at current market values, meaning someone who buys a home at $400,000 in a market where the previous owner paid taxes on a $200,000 assessment is immediately taking on dramatically higher annual costs. These are not temporary market conditions. Insurance repricing for climate risk is structural. Property tax assessments reset at purchase and rise from there. The carrying costs of home ownership in 2026 in many American markets are genuinely permanently higher than they were 5 years ago, and they are not reflected in the mortgage payment that most buyers focus on. 5. The opportunity cost of the down payment in 2026, $80,000, is a conventional 20% down payment on a $400,000 home. That is also $80,000 that, if invested in a broad market index fund and left for 15 years at a historical average annual return of approximately 10%, grows to approximately $334,000 to $34,000. The home also appreciates. Between 1990 and 2023, U.S. home prices appreciated at an average rate of approximately 4.3% annually in nominal terms, and significantly less in real terms after accounting for inflation. In some markets and some periods, appreciation has been dramatically higher. In others, it has been lower or negative. But the comparison is not just appreciation rate, it is total return. The investment in an index fund compounds without carrying costs. The home appreciates but also costs money every year: taxes, insurance, maintenance, interest. When you subtract the carrying costs from the home appreciation and compare the net result to the investment alternative, the investment often comes out ahead, particularly over holding periods of less than 10 years, and particularly in high rate environments where the interest cost of the mortgage is substantial. In 2026, with mortgage rates near 7%, the carrying costs of home ownership are at their highest in decades, which means the opportunity cost of deploying capital into a home is also at its highest. Because the alternative investment in the market has a lower cost of participation and a historically competitive return expectation, this does not mean never buy. It means the hurdle for buying to beat renting in 2026 in a high rate environment with elevated home prices is higher than it has ever been for most American buyers. The comparison deserves to be run with current numbers, not inherited assumptions from a market that existed 3 years ago. 6. Markets where renting clearly wins in 2026 in the break-even calculation. The price to rent ratio is the number that tells you how expensive it is to buy relative to renting in a given market. You calculate it by dividing the median home price by the annual rent for a comparable property. A ratio below 15 generally favors buying. A ratio above 20 generally favors renting. Between 15 and 20, it depends on individual circumstances. In 2026, the following markets have price to rent ratios that clearly favor renting. San Francisco is running approximately 33, New York City approximately 26, Los Angeles approximately 28, Seattle approximately 24, Boston approximately 23, Miami approximately 21, Denver approximately 20. Austin, which saw dramatic appreciation during the pandemic boom, is approximately 19. Even markets that were historically more affordable have seen this ratio climb. Phoenix is approximately 18. Nashville is approximately 17. Markets where buying still makes reasonable financial sense include parts of the Midwest and South, where prices are lower and ratios have not become extreme. Portions of Ohio, Indiana, Kansas, Missouri, Arkansas, and Mississippi still show price to rent ratios in the range of 12 to 16, where the math can work for buyers planning to stay long term. The break-even horizon, how many years you need to stay before buying beats renting, in a high-cost market with current rates is often 8 to 12 years. In the most extreme markets, it can exceed 15. If you are buying in San Francisco with any possibility of moving within a decade, the probability that renting would have been the better financial decision is very high. In a lower cost market with a price to rent ratio under 15, the break-even can compress to 4 to 6 years. Still not immediate, still requires staying, but attainable. The break-even calculation is the honest version of the buy versus rent decision. It accounts for all the carrying costs, the opportunity cost of the down payment, the transaction costs on both ends of the purchase, and the appreciation expectation. Most people making this decision have not run it. Most people making this decision are running the wrong comparison, rent versus mortgage payment, and arriving at an answer that does not reflect reality. What this means practically in 2026, if you are in a high-cost coastal market with a price-to-rent ratio above 20, are not certain you will stay for at least 8 years, are in an early career stage where income is still climbing, an opportunity for geographic movement is high, or would be stretching financially to cover the carrying costs of ownership. Renting is not the financially weak choice. It is the financially strong one, the culturally uncomfortable one, the one your parents may not understand, but the correct one for your current circumstances. If you're in a lower cost market with a price to rent ratio under 15, have stable income that comfortably absorbs carrying costs without financial fragility, have a down payment that does not deplete your emergency fund or investment base, and are planning to stay for at least 5 to 7 years. Buying may well make excellent financial sense. The cultural advice is not always wrong. It is just not always right either. The honest decision requires the honest calculation, the price to rent ratio in your specific market, the break even horizon at current rates, the full carrying costs, including taxes, insurance at 2026 pricing, and maintenance reserves, the opportunity cost of your down payment. All of it, not just the mortgage payment versus the rent check. In 2026 America, the housing market has not corrected back to affordability. Prices remain elevated, rates remain elevated, carrying costs have risen structurally, and the cultural pressure to buy has not adjusted to any of this, which makes running the honest calculation more important now than it has been in decades. Renting is not throwing money away, it is paying for housing, so is owning. The question is which payment structure in your market at your stage with your numbers makes you financially stronger over time. In 2026, for more people than the cultural script acknowledges, the honest answer is renting. If this challenged something you assumed was settled, leave it a like and share it with someone who is about to make this decision. Subscribe, because this is what we cover here.